what day is it today? 14th of October. Yes. So we've just seen Kwasi Kwarteng sort of resign.
Second shortest living chancellor in history.
So we might see a U-turn on the mini budget. That could well happen.
Parts of our mini budget went further and faster than markets were expecting.
We might see a reverse on the corporation tax.
Another major U-turn on her economic plans, a rise in corporation tax.
Liz Truss has got an interview this afternoon.
I am resigning as leader of the Conservative Party.
And accepted His Majesty the King's invitation to form a government in his name.
There's no solving, there's no solutions, there's just arguments, and everyone's getting more and more entrenched in their sides, and I think that's a major problem with the political situation sort of set up in this country. There's been a lot of wealth created in this country, and I think the redistribution of that wealth has been poor. It's going the way of America. If you can't afford to put your heating on, feed your kids, that's not something that can afford to wait for 18 months' time. They've effectively driven an aeroplane crashing nose first into the tarmac.
Anthony,
hi.
Thank you so much for coming on the show. I've been a bit excited to get you on, to be honest, just because of the current cost of living crisis and kind of announcements and everything that's going on. There's so many people out there that are nervous and unsure about the future, me being one of them, what these sort of changes and announcements mean to them in actual everyday life. And I just thought it'd be worthwhile getting you on, kind of breaking it down into layman's terms and going a bit more into depth with it, as opposed to watching a TikTok or a tweet for someone that might not know.
Yeah.
So if we take it back a little bit, just some background on yourself. You're the managing director of First Wealth.
That's it, yeah.
Which is a financial planning company.
Correct, that's it. So yeah, First Wealth, based in London, set up in 2009, Chartered Financial Planning Firm of the Year, and also a certified B Corp as well. So we do financial planning, wealth management, and financial coaching.
Amazing. Now, you set up in 2008.
Yeah.
Interestingly enough, straight after the recession.
Yeah.
Talk to me about that a little bit. How and why did that come about?
It was kind of a point where it's like, things can't get any worse than this. So we've been thinking about going on our own for maybe 2 or 3 years before. We started talking around numbers about whether we could launch it with my business partner, Rob. And then the financial crisis came and the world fell apart and everything that we assumed we knew sort of disappeared. And we just thought, now's the time. It's so unsettled. If we can make it stick now, then we can do it anytime. And we just, we sort of took the leap of faith and set out then. And it, it's like setting up any business, isn't it? Hard. It's always hard, but the first few years were tough. Well, we built some momentum with clients, but I think setting up in that difficult time gave us that discipline around expenditure, income, making sure that we're navigating those waters so that everything that's happened since, including what's happening now, even including COVID, it's felt relatively minor compared to the financial. I always think the financial crisis was the biggest thing that I probably will face in my career. And I still think that is the case, albeit there is a lot of stuff going on at the moment that doesn't feel particularly comfortable either.
Yeah, it's incredible. Yeah. Some resilience as well to go through that.
Lots of ups and downs, but we're here today and, doing all right. So it's good.
And why the finance industry? Is it something you've always done or studied, or what did you kind of do earlier on?
Long story. I mean, I studied economics at Bath University.
Okay.
I had a girlfriend at the time who was a couple of years younger than me. I wanted to stay in Bath. I just literally got the yellow pages and just wrote to a load of companies in Bath and Bristol saying, have you got any jobs? I got 2 responses. One of them was an accountancy practice. I went to an interview and got thrown out, didn't get in there. And then the other one was a company called Chase DeVere, which is a financial planner. And they said, look, you're 20 years old. You're very young. We like you. You're quite tenacious. Go and do some exams. So I did the exams and I knocked back on the door and said, look, I've done those now. And they were like, this kid's not going away. And they just gave me a job. So it was kind of luck rather than more than judgment. And then split up with my girlfriend like literally 3 months after. But it was, from a career perspective, it just gave me a start in a company. And then I got on with it. I loved it and had some amazing people to sort of mentor me. So yeah, that was a bit of a chance thing really. But that was the start way back, 96.
Wow.
Yeah, long time now, getting old.
I was 8 years old then, sorry.
Yeah, exactly. There we are.
I actually had a period in my life where I wanted to get into financial planning.
Okay.
I finished school and I kept going back to college. I was the guy that didn't know what I wanted to do and kept going back to try and study a million different things because in the family, no one had been to uni. And my dad was kind of like, go to uni, son. But it kind of just didn't fit with how my brain processes information. And I started the financial planning. It's like 7 parts, isn't it?
Yeah, that's right. It was like FP1 back in the day.
Yeah, so I did FP1 and then I quit.
Yeah.
If I'd have done FP2, I know now I probably could have been a mortgage advisor.
Well, the problem
Or
is
has that changed?
the way that it works is that FP1 and now it's called RO1. It's like a baptism of fire because it's all about regulation. It is the most tedious exam. So with what we try to do with our team now is go, don't start there. Go and find out some of these, like start on investments or pensions or mortgage, because at least that's a bit more interesting. And then once you're almost at the point of getting sort of signed off, go and do the regulation one because you won't be broken. But I think that going at the regulation first, it can break people because it isn't that interesting.
I can imagine, yeah.
Yeah.
I didn't even complete the first bit.
No, well,
It was
that's
it was like a folder about 2 inches thick.
about the history of regulation of financial services in the UK. I mean, what could be more interesting than that?
And I felt like growing up, you don't really get taught anything about money, how it works, the financial system.
Yeah.
You know, I've read obviously Rich Dad Poor Dad. I don't know if you have as well or not, but there's quite an interesting book about that. And I didn't grow up with parents that, you know, have you got any kids?
Yes, I've got a little daughter, Lux. Yeah, 7 years old.
Oh, amazing.
Yeah.
Amazing. So obviously, as she's growing up, you might be able to advise her a little bit about, you know, how money works and how the financial system works.
Yeah.
I didn't have that at all.
No.
And I feel like the education system doesn't really teach you any of it.
No.
What's, in your opinion, obviously you've got a daughter that's growing up.
Yeah.
Would you think they should teach more of it? What would you change if it was you doing a curriculum in school?
Yeah, I mean, it's
from like a money and finance perspective.
yeah, it's bonkers that there is no basic financial stuff in schools. I mean, it's crazy. There's stuff that you do learn about. You know, we're still learning
Algebra.
about calculus and trigonometry and all this stuff, which is fine, but you never use that in real life. So yeah, sort of fundamentals of financial services and how bank accounts work and what a mortgage is and what an interest rate is. It would be sensible to have that on the sort of financial on the curriculum, I guess, from school's perspective. So just on that, I think I mentioned we're a certified B Corp. So First Wealth is a company that wants to do things that are good for society rather than just making money. So we actually have another business that's called Thrive Money.
Okay.
And it is a financial education business.
Wow.
So the timing of this is quite good because it literally goes live tomorrow.
Okay.
So anyone who wants to check it out, it's on Instagram. So it's Thrive Money HQ. And that's a free financial tips thing that we do for people saying, this is what you need to know about interest rates or mortgages or cryptocurrency. It's basically the beginnings for maybe millennials and Gen Z, because there's so much nonsense out there, you know, on Instagram about crypto and Forex changing, a lot of dangerous stuff. So we thought, you know, as a sensible business, we need to bring some decent, hopefully, views to that. So we've got about 20,000 followers.
That's good.
And we are launching our financial foundations course. It is tomorrow. Good timing. Where we've created a series of videos, and it will be a paid course, but this is what you need to know about financial. We're a bit more in depth. And we've also built a tech platform which allows people to sort of go and do their homework. So understand your expenditure. There's an open banking integration. It's a bit about risk, understanding your personality, your mind, how it thinks about work. So Founding 50 goes live, and then we're going to launch the big course in January. So we've taken exactly that view that our business probably deals with high net worth entrepreneurs, but there is a lot of people out there who will benefit from sensible financial planning. So that's what we're doing at the moment. Yeah, Thrive Money.
That's incredible.
Yeah, it's good. It's exciting.
And if these people that follow this account, is there tips that go out for free as well on there that they can sort of benefit from?
Yeah, exactly. So the Instagram page will just go out, it posts sort of once a day or sort of, and that will continue as a free tips, trying to build that community. And then the Founding 50 is the bit we're going live with tomorrow. So it's got 50 people who have got a subscription for the course, almost like a beta test to say, come on board, have a look at this. What do you like? What don't you like? What do we need to change? And then the main course will go live in January. We've had a bit of a 2 or 3 months of looking at that. Yeah, but yeah, check out the Instagram page. And then there's a website, Thrive Money HQ. Check that out as well. If you want interested for the course in the future, register on the newsletter. So that's all happening very much live at the moment.
Nice.
Yeah, it's exciting.
Very. Sounds it.
It's cool. Yeah.
Now you're an employer, right? So you've got, I mean, how many people work for the
about 22, 23 people, yeah.
With the cost of living crisis?
Yeah.
What plans do you guys have as a business to sort of help the team and the business?
Yeah.
To keep them, you know, in jobs or, you know, being able to afford to live, etc.
Yeah.
Is there anything in place from your perspective?
Yeah, I mean, we sort of, so as part of our B Corp status, then there's 5 parts to that part of the review of the business. So clients, how you look after your team, information with the environment, how you deal with your community, and how you govern yourself. So a big part of that is how you look after your team. So, I mean, obviously there are issues there around pay, remuneration, bonuses. So we don't have a index-linked income. We've never subscribed to the idea of every year you get an inflation link, but what we do keep is a spreadsheet that says, since this person's joined the business, what has their sort of trajectory of salary been? And we always will make sure that it's always ahead of salary. So we know those numbers. The biggest change, though, probably for us is around working from home. So what we've done is after COVID, we said to all of the staff that they can work from home as many days a week as they want to. So we haven't mandated time in the office. So what that's done is, for a lot of the team, it's been quite a reasonable reduction in their costs of transport. So hopefully that's, for several members, it'll be, thousands on, if not multiple thousands of pounds of savings. So, that's helpful as well. We do things like, we have a benefits sort of HECA, which is a welfare thing that people have a sort of monthly allowance where they can use it for gym membership, or they can get food delivered to their home. So that helps. So we try to do as much as we can. That said, we got on the call the other week and said, look, my goal, like we did with COVID, is that whatever happens over the next 12 to 18 months with the economy and with recession, we will stay together. So we didn't lose anyone during COVID. We didn't have anyone furlough. This will be the same with this. I'm very much about trying to look after the wider team. Yeah. If that means that we have to be disciplined around pay rises for everyone over that period, then that's what we need to be. But I'd rather do that than you're out. I don't like the idea of redundancies. That's just not what sort of business we are. It's kind of, we're in this together. Let's get through it together. And if we can survive this, then we're out, and we can then sort of remunerate everyone accordingly. So it's I don't know how it's going to pan out the next sort of year, but the clouds are around. But we've been here before. We've done it before, so we'll be all right, I'm sure, this time as well.
Yeah, I respect that, and it's forward thinking.
Yeah,
very forward thinking from you. It's a tough one, isn't it? Because I'm also an employer.
Yeah.
And across all the businesses, there's probably over 200 people that we employ.
Wow, amazing.
There are multiple businesses. Now, it's very hard, don't you think, as the sort of business operator, to find a balance between your sort of commercial obligations, because you are trying to run a business, and it's also getting tighter for you, and your moral obligations. Correct. That you're messing around with these people's lives, and it's their wages and it's their livelihood. Yeah. It's quite a tough one.
It is exactly right. And I think most people get it. Most of the team, we try to be very, very transparent with our team. I mean, all of our company financials, we publish them, all the quarterly accounts, our full annual sort of statutory accounts, they're all on a team. So anyone can see exactly what's going on. We'll go through it. People know what profit we're making. We even discuss what the directors are earning as well. So people can understand, if there aren't, there's a balance, like you're right. The balance is the business needs to be here and functioning to make sure that we're all employed.
Yes.
If we grow the pie, there's more to distribute. But if we don't grow the pie, there's only a finite amount of money. And in order to make sure we're all employed, we have to accept that. So it's always about trying to grow the business. But yeah, I think there's I don't know, it's just sort of the business, or maybe it's who I am, but the business is, we're very much, I don't want to lose anyone on the journey. It's people have trusted us to be their employer. They work hard. So we've got an obligation to look after people.
Mm. You sound like a people person.
I try to be. Yeah, I try to be.
I like to think I'm one of those as well. Yeah. Now, you're running a business. You're at the top of that sort of hierarchy, as it were, in old school terms.
Yeah.
It's quite lonely at times when you're running these businesses. So how do you cope with the pressures, the stress, for your mental well-being? Is there anything you do? Is there any hobbies, or is there a way that you stay on top of it? Because you're quite a positive guy.
Yeah,
in a very stressful industry.
Yeah, it can be. A lot of it is mental attitude. It was interesting that when COVID came, I decided at Christmas to give up drinking for a period of time.
Okay. How's that going?
I started again. But it was just at that time. It was kind of, from Christmas, I'd done 2 or 3 months, and then COVID came, and I felt so positive. And what it showed me is, if you live cleanly and healthily, you can deal with the most shit situations and feel like you can cope with anything. So I just extended that period. I just got through 6, 7, 8 months. And while the world was kind of falling apart, I was like, it's all right, I can handle this. And it was amazing. It was mind blowing, actually. I got into triathlon. So I do a lot of, cycling, running and swimming. I go to the gym. I play golf. I love being outside. I like going, go surfing. I like to go skiing. That's kind of what I'm into.
Amazing.
I like being outdoors with my family, anything like that. And I listen to a lot of music. I've been trying to get into DJing as well.
Really?
Yeah.
I'll give you a set at the club.
Yeah, no, unbelievable. I'm sort of banging to that. So,
what kind of music you DJing?
A sort of techno, sort of house techno party would be my thing, or maybe either a sort of Latino set as well. Okay. So they're the two genres I'm sort of into. My other half prefers the Latino one. My probably go-to would be the house techno, but it's a bit heavy, so just keep the volume down on that one. But I think that's why I grew up with that sort of stuff.
Yeah.
So that's it. But I also have a coach as well, a business coach. So I jump on a call with her like once every 4 6
That's interesting
6
that you've
weeks.
got a business coach.
I need it. Just to sort of download what's going on, what's on your mind.
Business coach, is that another word for a therapist?
No, I don't think so. It's more, I think a coach will help you to... A good coach I'm a qualified coach as well. So a good coach, you know what's coming, but what they do is they ask you the questions, the open questions, like what's going on? What
to get you thinking about it.
What do you want? You got all the answers inside you, right? But you just need a facility. You need an hour and a half where someone's asking you questions and listening, and you talk out the issues. And by the end of that session, it's like, I had one yesterday, and it was all those things that were in my mind. This is a bit of a tough period at the minute. I've got a few things going on. I had a pretty clear idea. And so you go away from that going, right, and that's it. So then you have a 4 to 6 week period, right, I've got a plan, I'm going to implement that. What's going on again? So I think having someone to, whether it's a paid coach or whether it's just someone you trust, I talk to my brother a lot. He's quite high up in Barclays, and we have a steer, like, this is what's going on, what do you think? And I trust him. He's a sounding board, and he'll say either, Ant, you're an idiot, you shouldn't be thinking like that, or he'll say, yeah, you're on the right track with it. So I think talking to people at work is important, but I think you also need to have conversations outside of work who are looking at it, because often there's a lot of relationships in the office and one person affects someone. So someone can come out of it from an outsider's view and just go, yeah, you got that right, or you got that wrong, or what about that? I think is really powerful.
Very, very. Yeah. I'm pretty fortunate, like you, that I have not a brother, but a few people around me that I can sort of really talk about openly and honestly subjects. But I do also go and see a therapist once a month.
Okay.
And obviously what you've explained is pretty much the same as the business coach thing. So we talk about issues that I might be having or anything in general, and this person, she will sit with a bird's eye view with no emotional attachment to the subject, whereas I have one.
Of course.
And as you said, all the answers are in me.
Yeah.
And I can give great advice. I just can't take my own.
No, yeah, and it's a really valuable thing, and it's actually interesting. So, for years I've been a financial advisor, and the financial advisor really is clients come to you and you've got the solution. So, right, I get your situation. If I were you, this is what I'd do. Bang, bang, bang. Right,
you're
done.
Like a problem solver, aren't you?
As an advisor, you are, absolutely. But what is interesting now is our world. The really good advisors are almost coaching first before advising. So it's kind of rather than...
So giving the tools.
Yeah.
Like the fisherman quote.
Yeah, exactly. So I would be asking, if you were my client, all right, what's going on in your world? What are the things you like doing? What are the things that make you happy? What are the things that wind you up? How's your business going? What's the sort of direction of travel with it? How's your family? Trying to get a little bit more from you, because you'll answer me, you might be asking, well, actually, I need to fund my pension, but I need to know a little bit more about it, because actually it might be something completely different. So we're trying to build, talk a lot around life goals, values, responsibilities, and trying to help people to live happy and fulfilled life. We do a lot around well-being as well, not just financial well-being. I think so many people get caught on this idea that the only return in life is financial. So I look at what yield am I going to get? 7 or 8%. It's like, is there another way of thinking about this? What do you mean? Well, how much anxiety have you got? Chasing the dollar. Well, I'm stressed out all the time. I can't sleep. Well, if you sorted that out, then it's no financial return, but you can sleep at night and you can wake up in the morning, feel good about yourself. I've not thought of it like that. Right. So that's that. I think as you get more experience, that stuff is more valuable than so much of what we do. If the solution is then a financial thing over here, we do that as well. But I think a lot of people are not clear on what they're really trying to achieve, and that can create all sorts of bad outcomes.
I think that's an incredibly unique sort of way of looking at it. I've met a few financial advisors in my time, and they don't normally care as much as what you're talking about. I'm broadly speaking about my own experiences.
Yeah, no, that's fine.
They've generally been less about me and the tools to know what I'm doing, and more about maybe their commission of what product they're going to sell me.
And it's there is a lot of our world has evolved hugely. I mean, I go back 20 or 25, 26 years when I started, it was very much about that.
Yeah,
I didn't need to know anything other than like, here's a product and how do you sell it, and that was it. That's how I got paid. But now it's kind of it's sort of coach, listening, mentor maybe for some clients, understanding the interrelationship between personal finance, business finance, people's well-being. It's a really sort of rounded part of it. And, that's the bit that, probably get the bigger clients that come to you. They might come out of a private bank where they are very much talking about the client's money, and that's it. What's your yield? What asset allocation you got? Where it's like, right, don't worry about that. Tell me about you. I'm interested in you, not your portfolio.
Yeah.
And it's a different way of doing things. So it works for us, and it's it's how we're trying to grow the business.
Do you ever struggle? I mean, it's quite big decisions that people coming to you for, aren't they?
Yeah.
They're relying on you.
Yeah.
Do you ever struggle giving them that advice? Have you ever, I put it in inverted commas, made a mistake or given some advice and then gone home and been like, fuck, probably shouldn't have said that, or I shouldn't advise that. Do you know what I mean?
Yeah, no, it's sort of
or is there like a bit of a guideline of what you guys do and it kind of all follows the same path?
It's a really interesting question. The answer is, because we're quite sort of disciplined, as long as you go through the process, the outcome is fairly easy. So I'll give you an example. So investment is a big thing, right? Where do I invest my money? So we run what's called an evidence-based approach. So we rely on the data to say, based on all of the data on the last 100 years, this is the right way to invest your money. You can't argue with it. This is data-driven. Now, some clients will argue with it. And if you go to a lot of wealth managers, they'll also argue with it, because you'll go, no, I know that's the data, but I'm the 1 in 100 that can outperform the data. Oh, you're that one. Okay, good. And then, you know what? 6 months later, they ain't that one. So what we try to do is to say, here is a data-driven approach to investment that we know, therefore, is the best way to do it.
It's now, no bullshit approach, isn't it?
No, exactly. And, it's the problem with most wealth managers and most fund managers is that they will tell you that they are the one who can outguess the stock market, right? We know it's not, we know it doesn't exist. That you can't do it. You can't do it consistently. So that's
not legally anyway.
No. And it's all, exactly. It's all proven by data. So therefore, this is the way we do it. So actually what it does is it removes quite a lot of that difficulty around how do I invest my money. It's like, well, this is what the data says. This is all the evidence, and that's how we do it. So it actually makes our job quite easy. The difficult bit is getting the clients on side in terms of what exactly are your objectives. And sometimes the objectives a client comes in with aren't really the objectives. So I need to grow my money. Well, what for?
Yeah.
It could be, I need a bit more, right? I need to
grow. And by how much?
Yeah, and that's right. I need to grow my money because I want to retire in 3 years' time. Okay, well, tell me a little bit about retirement. Well, what does it look like? What are you doing with your time? How are you going to afford it? And get people to visualize what they're going to be doing. And actually, you know what? You don't need to grow money at all. You've got enough. You could do it today if you wanted to, or 3 years, mate. You're probably a little bit optimistic there. So, but I need to know. So it's that conversation rather than you want capital growth. Give me a check. Right here, you're done. That's the easy bit. The better bit is to say, tell me a bit more about that first, and then we'll work out what the right thing to do is for you. So it's just going a bit deeper with the advice.
Yeah, makes sense. Makes sense. I wanted to touch on something mortgages.
Yes, mortgages. Yeah, hot topic.
It is a hot topic. Yeah. And it's hot for me as well because mine is due. So I've got I had a 2-year fixed mortgage at 1.59%.
Yep.
It's due for renewal in February, and I've obviously got the letter through from Santander saying, "Oh, you need to do this."
Yeah.
I've rung my mortgage advisor saying, "Look, this has come through."
Yeah.
And everything I'm being offered now is just shy of 6%.
Yeah, it's
5.94, 5 point. Now, I was chatting to my wife about this. So our mortgage is going to go up about £1,100 a month.
Mm.
Now, that's over, $13,000 a year.
Yeah.
I need to be probably earning 25,000-ish by the time I pay gross, my 40% tax to net that.
Yeah.
I mean, how on earth are people going to deal with this? Like, I might be fortunate enough that I could do one more event or two more events and pull that kind of money in.
Yeah.
But if you were someone that was on a salary of 25,000, 30,000 a year and that happened, it's just unsustainable.
Yeah. Yeah.
I mean, what any advice you'd give to those people? How do they sell their house and downsize? Do they leave it variable? Do they fix it?
It's a really difficult question.
It's tough, isn't it?
It's really hard. And you're right. there's people who, I mean, the first thing is just, it's very difficult to see a way around it. So just in terms of what to do, I mean, the conversation really at the moment, if you've got a broker, have that conversation as soon as possible. So I think you can wait till your fixed rate is up, but some of the banks will give you the ability to have a conversation with them and maybe look at rates and book rates in advance. So it's worth either speaking directly to your current mortgage provider, or if you've got a broker, speak to them and say, look, if you do a deal with the existing providers, they tend to be slightly more friendly than go into the open market. All right. So if you can stay with where you are, then that's an advantage. If you're fortunate enough that you can flex your income, then that's beneficial. You're right. If you're self-employed or an entrepreneur, you have the ability to work a bit harder, do something else. Yeah. Same if you're employed. I mean, potentially there to generate some more income as well. So your costs are going up. If you can generate a bit more to come in, then that's obviously it's a potential way of getting around it.
It's quite scary, though, isn't it?
It's frightening.
I think of friends that are, earning X amount of money and maybe they don't have the capacity to earn any more.
No, and you're right. It's not. It can't be done for them because a lot of people work flat out and they've got kids. It's just you can't more than 24 hours a day, and a lot of people are working hard. So, I think it's going to be a challenge. I mean, the benefit of the first thing to say is I don't see this going anywhere other than where we are today. I mean, we are doing this interview today on what day is it today? 14th of October. Yes. So we've just seen Kwasi Kwarteng sort of resign in inverted commas or
on
sacked.
the way here. Yeah.
Liz Truss has got an interview this afternoon or a press conference. So we might see a U-turn on the mini budget. That could well happen. The markets, though, bond markets, which ultimately drive mortgage rates, have been sort of in absolute sort of volatile since that mini budget. The problem has been that I think where we're getting to with interest rates and mortgage rates is longer term. If you look at a 50 or 100-year, the rates we're seeing now are quite normal.
Okay.
But because of what happened post the financial crisis, we've seen so much quantitative easing and monetary policy that's kept interest rates artificially low. Now, ultimately, we need to return to a cycle where those base rates are higher, so the cost of capital is more expensive to stop inflation coming into the system. This should have, though, happened over a 3 or 4 year period, which should have been a gentle landing of an aeroplane over to make sure that people had the opportunity to get used to this. But what's happened is they've effectively driven an aeroplane crashing nose first into the tarmac, 100 mile an hour, and that's what's happened. So base rates they've gone up a bit. They're going to probably leap up more because of inflation, and mortgage rates then are going to go. So I'm not sure that we will see a dramatic decrease from where we are at the moment. And my gut feel is they might come off a bit, but we won't be going back to 1.5%, 2%. So the point around anything other than fixed, you are taking a risk, because I think base rates will go up further. I can't see anything other than that with what's happening with inflation. If you've got a fixed rate, you know where you are. So I guess what you need to be looking at is, where is my current level of income? What is my disposable? What do I spend my money on? And there might be some tough choices around what can I not afford to do in order to meet these requirements. So, for some people that might be a bit easier. It might be we need to take out a holiday. But for a lot of people, they haven't got that anyway. So then it's going to be much more difficult. So I think I wouldn't be rushing to sell a house at the moment, but I think it's going to be difficult for a lot of people, and there's no obvious way out of it. I can't see the government intervening on a mass scale to sort of back mortgages. I think the Bank of England has sort of made it clear that they're not going to continue to buy government bonds to keep rates low. So it is going to be difficult. But all I'd say, seek advice and speak to a broker or your current mortgage provider as soon as possible.
A few bits I want to jump on from there.
Of course, yeah.
Interestingly enough, you mentioned the base rate, and when I spoke to the broker, he was like, it's a funny period within mortgages at the moment, because the gap is so big between the base rate and the percentage of thing. Yeah. For me, does that indicate that the base rate is going to go up, and they're covering their ass, the mortgage companies?
Yeah, there's no
margin there.
Yeah, that's right. So they are. The problem with everything at the minute is because it's almost this unprecedented volatility, that pricing any assets is very difficult. So you're seeing such volatility with stock market as well. The stock market's all over the place. Bond markets are all over the place. House prices are resilient at the minute because if people are on fixed rates, it's not such a sort of liquid market. So therefore less volatility. Whether that will change is a different matter. But yeah, there is a huge, you're right, base rates, 2.25, mortgage rate 6, it's a big margin there.
3.5%, 4%.
Yeah, at the moment. But that base rate is predicted to go up to sort of 4 or 5%. So the market is anticipating
when? Do you reckon?
Over the next 12 months.
Really?
Yeah, we will see that. So Because
so actually fixing at 5.5, 6 doesn't sound too bad if it's potentially going to go up to 7, 8.
Potentially, although that 5 or 6% is probably already pricing that higher base rate. It's already in the market. That's the thing. So everything is about expectation. So if they're predicting a base rate of 5, then 6% mortgage rate. So they're already there.
Yeah.
So it would only be if they then started to think the interest rates will go to 7 that then they would add more on, if that makes sense.
Yeah,
so
yeah.
Inflation is sort of 10%. The Bank of England's got a problem because it's designed ultimately to try to control inflation. Inflation's at 10. This target rate is at 2. So they have a credibility issue as well. They can let it go and keep base rates down and know that will help homeowners, but then that sends a message to the market saying, actually, I know we're here to control inflation, but we kind of don't worry about that at the minute. So they have got a balancing act, but ultimately their goal is to control inflation, of which they are struggling and making a fist of it at the moment. And probably they acted too late in terms of raising interest rate. The sort of cat is out of the bag, but we might see a reverse on the corporation tax change that was announced in the mini budget, and that might have an impact on sort of government gilt yields and prices. So we'll see by the end of this interview. We'll see what's going on.
We might have to get the news up in a minute and see
have a
what's
look
going on.
Have a look at it.
Yeah. So what I'm probably going to do, because it's not till Feb, I was going to effectively pick a product now, just so I can guarantee what rate they're giving me now, and then nearer the time I can change it before I have to.
Correct. Yeah. It's almost having something in the locker as a sort of as a last resort sort of thing.
So you're saying you wouldn't sell a house right now?
No, I don't think so. I mean, it's
because I was going to move last July.
Yeah.
Put my house on the market for quite high, more than I thought it was going to go for. Had a London cash buyer buy it.
Yeah.
Put an offer in on a new house. It got accepted. Went to see my mortgage broker and he said, Ty, you've not had any income for 14 months because you're self-employed and it's COVID. You're not going to get a mortgage. Like not what you could have borrowed previously.
Yeah.
So I pulled back out. I still have an intention of moving, but it's like, it doesn't seem to be the right time ever.
No, there isn't. I mean, the thing is, if you are planning on moving, this is where it sort of comes back to this sort of thing around looking at things purely from a financial. A house is your home, right? So if you've got not enough space or you've got too much space and you are thinking about moving for those reasons, then still think about moving for those reasons. Where I struggle with is people who are trying to second guess the property market and interest rates to say, I'm going to do this purely for a financial reason. Invariably, you get things like that wrong because you can't second guess the market. It's very, very difficult to do it. So if you're planning to move for the right reasons, whether it's up or down or sideways, great, or you're moving to a different part of the country, then don't be put off, go and find out whether you can do it. But I think the idea of, trying to get ahead of it is difficult. And the market seems fairly strong at the moment, but it might, we'll see how things change. But
it was more the fact, like, they're valuing my house at the moment at top whack, like silly money. Yeah. So in sort of, and I know a lot of people are asking this, do I sell my house here? And obviously if I buy now, it's relative. So you're not actually gaining. Yeah. Do I then sit in rented for 6 months? Yeah. Let's see what happens with the interest rates, see what happens with everything, and then buy a house. Yeah.
Yeah. I think I would say that there will be, if I had my sort of crystal ball on the table now, I would say that in 2 years' time, you could probably buy a house for less than you can buy it today. Really? On the basis that if people are struggling to pay their mortgages, there will be more properties on the market. Yeah. And maybe more demand as well. So, because the problem at the minute, there's very little buying and selling, and that's the problem. So, house prices have been high because the sort of supply is very limited. The demand's been reasonably decent, so people have been paying top dollar. But yeah, whether the mortgage rates increasing will start to sort of unlock the marketplace in a weird way, and people will start to move, or it could go the other way completely. People will just go, right, we're going to batten down the hatches and just accept that we are going to have to go through this period of pain. We're going to make some lifestyle adjustments to do it, and we just stay where we are because moving is expensive as well. That's the other problem.
It is expensive.
Yeah.
First-time buyers. Yeah. There'll be some of them listening to this now, and I know when I put a thing up on Instagram saying, "Is there any questions for this financial planning expert?" A lot of them said, "I'm a first-time buyer. Do I sit on my hands or do I buy?" Yeah. What would be your thoughts on that?
I would, to go back to what I said earlier on.
Because it doesn't really affect them, does it, for a first-time buyer?
No, the thing is, if you're a first-time buyer, you are in rented, presumably, or your folks or wherever, you've got cash or you're saving up for the deposit. the natural conclusion of what's going to happen or is happening with interest rates is that there will be either a drop in house. I don't really buy into the idea of a housing market collapse, but I do buy into the idea of a sort of gradual decline in prices. A dip, which is, again, it's what happens, right? So
we're in a bubble down here, I always find.
Yeah, correct. So whether if I was a first-time buyer, again, if you need to move and you find the right house, move. Just, don't try to second guess. But if you are in the process of saving and you're trying to get on now, or whether it's in 6 months' time, I wouldn't be overly worried. I would probably just want to see what plays out. If it was my daughter coming to me today, if she was a bit older and say, right, Dad, I'm going to buy my flat for the first time, as long as we were still getting on, I'd say to her, you can stay with us for a little bit longer. We'll have to work that out. But let's just have a look at what happens over the next 18 months. That's that would be my gut feel. And
if your daughter came to you and said, Dad, she already owns a house.
Yeah.
She saved quite a lot of money up.
Yeah.
And she says, because the mortgage, to refix it, my mortgage is going to go up so much. Shall I just pay the mortgage off, or shall I invest my money into something else?
It's a good question. A lot of that depends on need. So for a long time, people have kept high levels of debt against their property because you can borrow money at 1.5%. So the question is, can you go to the market and get something better than 1.5%? And the answer is, well, equities, long-term equity returns, probably 7 or 8%. So yes, it's fairly easy, right? Yeah. Longer term, in the short term, volatility is all over the place, but I would expect most things to outperform 1.5%. Once that starts creeping up to 5 or 6%, and if you've got long-term returns on equity of sort of 7 or 8, that margin is much reduced. So you're taking on risk and you're creating a smaller margin. So at the moment, it's probably more towards, you probably could. But if we see the base rates go to where they are and mortgage rates 6 or 7, it probably favours paying down some of the debt. And of course, the benefit of paying down some of the debt is not just you're reducing your monthly payments as well. So if you have got a situation where you've got capital and you're struggling from a monthly perspective, by knocking down some of the debt, especially if you're on a repayment, it can have a significant reduction in your monthly outgoing. So if you're in that fortunate position, then that's quite a lucky way to do it. The downside, of course, you pay some of the mortgage off, that capital then is gone, so you haven't got the liquidity. So it's always a good idea to keep an emergency fund or a rainy day fund. But chipping down debt is always a good idea if you can afford to do it.
And I guess with a house, you're fortunate that if in 6 months, a year you need it, you can just remortgage again and pull some equity out.
Correct.
Yeah, subject to,
that's right. Changes in your own personal circumstances, like you were saying earlier. What's your income? Are there any changes to that? So there is always a view as like, right, is now a time to remortgage because I know where I am. What am I going to be going on with my personal life? Am I going to change job? Am I going to be self-employed? What my account's going to look like? So you have to take all that sort of stuff in as well, because the banks need to see some sort of proof of income. So if you've got significant change, you might want to have that conversation with them now ahead of anything. But yeah, it's there's all these sort of factors that come into play, and I think that's why having a chat with a decent broker or financial advisor who gets it, just say there are a few ways of dealing with this, and often one or two of them are not the right way, and one or two of them are the right way. But you want the client to sort of go, yeah, actually that feels right for me. Yeah.
I get it completely. Let's touch on something else. Crypto.
Yes. Yeah.
What's your thoughts on it? Do you advise any clients to invest in it? Have you invested in it? Have you dabbled in it?
No, I've never bought any, and we don't advise clients on it. The main reason is it's an unregulated investment. So there's no government sort of safety net. If anything goes wrong, you lose your money. The problem I have with it is just the speculative nature of it. So, obviously people who invested in Bitcoin early doors would have made a lot of money. If you'd invested in Bitcoin 12 months ago, you probably sat on paper losses at the minute, or in fact, most cryptocurrencies, some of them would have been a lot more. So do we feel that crypto has got a place longer term in the economy? I think the answer to that is yes. Blockchain technology has got a place. Has it worked itself out in terms of the application of that technology? I don't think we have quite worked it out yet. So I've never invested in it. We try to steer clear for clients. We don't advise it because it's an unregulated investment. But do I feel there is something there longer term? Then the answer is yes. But I would say to anyone, just be mindful of what you're doing. If you're putting anything into it, then I would assume that the value could be written to zero. If you're happy to take that level of risk, then go for it, have a punt, but certainly don't be investing money that you can't afford to lose. And people have been borrowing money to invest in crypto. So you've got that now double whammy. You've got the borrowing money at 3 or 4% or higher to then invest in an asset that's gone down. That's a double whammy of a problem. So, a lot of people listening to this will probably be thinking this guy's crazy. Crypto's the way forward. I try to understand both sides of the argument, but yeah, for our clients, it's not the right investment in terms of volatility at the minute.
I have friends that have dabbled in it that have done extremely well, and I have friends that have lost their shirt. And the volatility bit you're on about, it's like one tweet varies it. And I know it's similar with stocks as well, isn't it? It is similar. But if you've suddenly got an Elon Musk going, we now accept Bitcoin for Tesla, you suddenly see it shoot up. Yeah. It shoots down. Would you, if a high street bank created their own crypto, would you see that as safer?
No.
Rather than like a kid in his bedroom somewhere?
No, I don't think so. I mean, it's interesting that, the biggest bit around crypto is the Chinese government looks like they're probably the most interested in this. They're trying to develop their own cryptocurrency. I think they see the future of maybe changing the dimension of traditional money and moving towards crypto. So at the moment, most of the world currency is driven in dollars. Yep. I think China sees the opportunity to say, well, actually, we can build a sort of global crypto, which will become... So that's part of their longer term strategy as a government. So governments are getting into it. I think, what would I need to see? I would need to see, for me, I would need to see it as a regulated investment. So that there is some sort of proper process in terms of client outcomes. At the moment, it's a bit sort of Wild West. And most clients come to us to help protect what they've got. They might want to have a double with it on their own, but it won't be from us to say go and do this. If you want to do that, that's your funds. You play with it. Assume that can go to zero, but that's outside of the bit that we're going to look after for you.
Interesting. It's like unregulated, like you said, and it's a bit seedy as well, isn't it? You don't know who's doing what and who's spending the money.
We've seen so many. There's obviously so many issues. Some of the sort of hackers and some of the currency that's been taken away.
I've had friends that have had their whole wallets wiped out completely
and
by a hacker.
That's terrifying. Obviously that can happen with your bank account if you are.
You get it back. The bank reimburses you generally
normally.
Speaking.
But we had a client that we were aware of who lost over £1 million on a crypto scam, where one of their family members has said, look, have a look at this, got invested in, give us 20 grand, started with that, got a valuation, it's gone to 100, give us a bit more.
Like a long con.
Yeah, an offer, this is a new crypto launching, £500,000, do you want to get into it, it's going to go to X. And they did it, and it was all a scam, the whole thing disappeared. So...
a modern day Ponzi scheme.
Yeah, it was exactly right. And, we'd sort of said, be very, very careful, don't go anywhere near this. And they'd done it off book, if it were, outside, and they'd lost it. And it's, for those, that's a devastating outcome. That money's never coming back.
Absolutely.
And the bank won't reimburse it. It's a scam. It's gone. So yeah, I'm not someone who's going to write off cryptocurrency because I think it has got a long-term play in the economics and finance. But for clients of mine, then we're keeping out. Yeah. Yeah.
Everything in life, I feel, goes in cycles, right?
Yeah.
Generally, whether it's fashion, haircuts, music, whatever it might be.
Yeah.
Now, when we talk about a recession, is that not just a normal economic cycle that comes around every now and then?
Yeah. Yeah.
So should we not be as worried as maybe we're being made out to be when we hear the word recession? So like, even with current affairs, I'll double down on the question. Is it as bad as they're making out the scaremongering from the media?
No. I mean, the thing is, a technical recession is 2 quarters of negative growth, right? So the point I would make is if you had could you or I or anyone else, in fact, if it was a 0% growth, a flat line for a quarter, 2 of those, we're not in recession. GDP drops by 0.1% to 2 sort of quarters in a row, and that's a recession. Now, I challenge anyone, would you notice? Nothing will have changed. It's so small. So, and often, we saw the economy shrink by 0.3% last quarter. So we're not in recession yet, but we need to follow it up with another. But yeah, you're right. I mean, COVID was the largest recession we've had for 300 years.
Wow.
So it was massive. It was huge what happened with the economy because no one spent any money. We saw massive fall off of GDP.
When you talk about 1% drop, 0.1% drop in GDP, or let's say 5% drop in GDP.
Yeah.
Put it into layman's terms. What does that mean for me in everyday life? What is my milk going to go up? Is my bread going to go up?
All it is really is it's the sort of total value of all the products and services that the economy grows. Right. So if you take all of the companies, all the individuals, the sort of what we all make, that's sort of GDP essentially per person, and then per capita is per individual. So it's what you're talking is about. That is a vast number. And so
it's spread over a lot of people.
Yeah, and it's gone down 0.1%. So that number, so 0.1, it's kind of not even 1%. It's a tenth of 1%. So it's it's 1,000th.
Yeah.
You're
not going to notice it, really.
You're not going to notice it. No,
not in your everyday life. No.
So if you've got a recession where the economy is dropping by 5, 6, 7, 8%, that's a material difference. But we're sort of flatlining at the minute, and we've been flatlining for quite a long time. Obviously, post-COVID, we rebounded quickly because it was such a nightmare. But, that's why, again, the government's got themselves into bother because they've looked at the economy for the last sort of 10, 15 years and said, right, we're in a low growth environment. We need to do something radically different. And they've come up with their tax plans, which are all unraveling pretty quickly, to say we need to reduce taxes because we think that's going to be the way to get the economy growing quicker. But unfortunately, they haven't really priced it, and then the markets have gone crazy. So, yeah, GDP is essentially just goods and services across the country, a measure of total output. It's gone down a fraction. So, you're right. Recession is just boom and bust. That's where it always is. It's never changed. Is it like a type
of correction you get with stocks?
Yeah, a little bit.
Kind of.
Yeah, it's a typical. What happens is, it just could be anything like markets, interest rates tightening is a good example. People start spending a little bit less money, right? So, if you're going to be paying 5 or 6% on your mortgage, you might be looking at your holiday next year and thinking either we're not going to go, or I might spend $1,000 rather than $2,000. So it just
eat out less a week, that kind of stuff.
People start to tighten. So you are right. I mean, you can talk yourself into a recession and this sort of self-fulfilling prophecy of doom and gloom, which the media loves. It's the sort of good news is no news. That sort of idea. Yeah. So that's how markets and newspapers and sort of social feeds on bad news and negativity. People don't want to read it, but they're fascinated by it. And so I think one of the things that I try to do is you have to upskill yourself. This is all part of the normal journey. Same with stock markets. They go up, they go down. So with clients, we're just trying to tell them this is part of the journey. This is what happens. Every year they go up, they go down. Every 5 years we see a much bigger sort of correction. Same with the recession. So remain optimistic. We will get back to growth. This is part and parcel of any economic cycle. We've been here many, many, many times before, and we'll be here again in the not too distant future.
The mini budget.
Yes, the mini budget.
The reaction to this was obviously quite drastic when it came out.
Yeah.
I was going to ask you if you thought it was justified or if there was more to it. But obviously on the way here, the Chancellor's been sacked.
Yes.
Jeremy Hunt's been appointed.
Yeah.
What's your general thoughts on all of that?
Well, my thoughts, I have two thoughts really. I guess one is from a sort of economic perspective and the other one's from a social justice perspective. So let's start with the economics first. I mean, the problem is that they've cut taxes on what I would call economic theory. So the idea, economic textbook theory, that we're all rational individuals, you reduce tax burdens and people will work harder and create more produce. It's a theory, whether it's been proven right or wrong. I'm not really, I think the jury's still out with that, all right? The problem is, though, that we've just borrowed vast amounts of money to get through COVID, all right? So it's we spent a lot of money on COVID, like many countries in the world, rightly so, to save businesses and look after individuals. And we sort of then say, right, we have to repay that. So we had a strategy in place, right, we're going to put up corporation tax in order to start to pay back some of that debt to make sure that we're getting in control of the finances. What we've done is all of that prudence and sensible planning, that's just gone out the window. So we're just going to announce £45 billion worth of tax cuts and not really we don't know how we're going to pay for it. We think we're going to pay for it by an increase in GDP, gross domestic product, because people are going to work harder and that will create growth and we'll all have more money and that will pay down the debt. That's the theory. Right, so that's the economics. The market spooked because the market said, right, where's this money coming from? And all of a sudden they're saying, well, the UK government and UK economy is looking a bit shaky because we're not actually that confident that you can repay this debt. So what we're seeing is the cost of borrowing for the UK has gone up massively. And that's why interest rates have gone up. The gilt yields have gone up, spiked it all. So the bond market has said, we are having a negative vote on the UK because we're worried that you won't be able to repay this extra money. So I compared it the other day to someone like, right, we're going to go on a 20 grand holiday. We're going to put that on the credit card. Right, once in a lifetime. It's my birthday. We're doing it, right? But when we get back, we're going to be super disciplined and we're going to pay that credit off before we do anything else. That's the plan. Fine. Good idea. They've done that. They come back and they said, we've had such a nice time. We'll just do another 30 grand on another credit card and we won't worry about it. And everyone's looking at it going, that's really not very good. So if you borrow money, that's fine. You've got to pay it back. You can't just keep going on this cycle. And that's where the market's just gone, that's no good. So economics is the jury's out. The market's jury's wasn't out. It's like, this is done work. From a social perspective, everyone's in pain, right? People are struggling. You've got the energy crisis. You've got interest rates going up. You've got mortgage rates going up. People are suffering in this country. So what they did in terms of cutting 45% tax is just unbelievable. It's unforgivable, really, in terms of the potential to sort of benefit 1% of the country when 99% won't benefit from it. If you're trying to win hearts and minds, I just think it's the most crazy policy that anyone could have come up with. So the fact that Liz Truss and Kwasi came up, it sounds like they just came up with the two of them. No consultation of the OBR, the sort of Office of Budget Responsibility. No consultation with the Cabinet or the Bank of England, like two people like you and me. Let's make up some economic policy and throw it out there. Oh, that didn't work. That's a car crash. It's actually mind-boggling. So yeah, it's unfair. It's unjust. People are even the Conservative Party, like this is the bonkers. So you're now, looking at that Conservative government thinking I don't know how they're going to get any chance of getting re-elected in 2 years' time. So it just felt unfair. It just felt so out of touch with what is going on in this country at the moment. And that was why I think so many people got upset by it. It's the same with the corporation tax. I mean, the corporation tax was 19%, so it's a tax on businesses. So at the minute it's 19, it was due to go to 25. You run a business, I run a business, right? It's painful, but we've got to pay back the COVID loans. We planned for it, right? We've seen this coming for the last 2 years. So they then sort of said, well, we're not going to do that now. We'll keep it at 19. So again, that's an unfunded tax cut, right? Where's that money coming from? Oh, that will come from the money tree, the secret money tree that may or may not work. And I think, again, the markets have gone, nah, that's it. So I wouldn't be surprised if we see a U-turn on that policy, maybe this afternoon, say the plan, the cut to not go from 19 to 25 is now being reversed and we will go to 25 from April next year. We'll see, but I wouldn't be surprised if that's the outcome by the end of this chat.
Yeah, I wouldn't be surprised.
No.
Do you think the damage is done?
Yeah, damage is done in many ways. Politically, the damage is done. Economically, the damage is done. From a trust perspective, I think the government's fallen out with the Bank of England. Markets have fallen out. I don't see... The problem is the cat's out of the bag. I don't see prices of gilts just reverting back to where they were 2 weeks ago. It's kind of, there's been pressure for these things to sort of leap out. But again, what the government should have done with the Bank of England is a sort of gentle runway of repricing assets so people get a chance to get used to it rather than this absolute aeroplane car crash straight into the tarmac where everything's gone up and everyone's like, how are we going to deal with this? And I think we don't know what the answer to that is yet.
I mean, the pound as well has plummeted.
Yeah.
And you've got this perception. I've been quite fortunate. I was in Dubai last week for a bit, and the week before, me and my wife went to New York.
Nice.
But the exchange rate, I was in Ibiza last month.
Yeah.
It's almost the other way around now.
Oh, mate, honestly.
And the perception in Dubai, everyone was speaking to, you used to walk around there when you said you were from England, in any other country, you had like this power about you because your pound was strong.
Yeah.
In Dubai now, they're all taking a mick out of you. You guys are folded. The country's falling apart.
Yeah. No, well, funnily enough, I'm going to Arizona on Monday, so I'll be the same. Every pint I drink is going to be expensive. But
we went to New York and it was literally pretty much 1 for 1.
Yeah,
so something that was $200-300 that you'd normally go like that with, it's £200-300.
Yeah, it's expensive, right? It's going to be expensive. So, yeah, I mean,
what does it mean, the pound dropping? What does it actually mean? Like, why has it dropped? How's it going to come back?
It's just basically
printing more money.
Yeah, so it's an element of that. So it's kind of like how other.
If anyone that's listening that might not understand how the kind of financial stuff works,
it's an interesting one. So broadly speaking, the pound dropping is, if you can imagine, like different currencies trading against each other. It's effectively a bet against the UK economy. So it's to say, right, if I had the currency of the pound against the currency of the dollar, which economy do I think is stronger? So if I think America is going to be stronger, I'll just convert money to the dollar. So the dollar strengthens and the currency of sterling goes down. broadly speaking.
Yeah.
So that's the simple explanation. But you're right, there's more to it. So if the government feels like they are going to need to, they've got this hole in their budget, i.e. they've cut all these taxes, but they've got to repay this. They will do that by issuing more government bonds, potentially, where they basically, it's like raising finance. They will go out and say, right, we're going to borrow 100 billion quid and we will give the people who buy these bonds, we'll buy them back in 10 years' time. We'll give you what's called a coupon or an interest rate, 4 or 5%. So if the government or the markets feel that the government's going to have to issue more bonds, which potentially they will if they can't afford to meet their liabilities, then that creates additional currency, essentially sterling, which then sends the price down as well. So it's a kind of it's really a vote of, I think, the vote of confidence or lack of confidence is roughly what's going on with any sort of currency and how it's working out.
Yeah, as I said, when I was in Dubai, I had friends that buy quite a lot of stuff, and they said they used to buy in pounds out there and dollars, and now it's euros or dollars. No one will accept the pound. No, it's too volatile. I've never heard that about the pound in all my life.
It's crazy. I mean, they say it dropped to 103 against the dollar on the day of the mini budget, which even the week before was like 115, 120. It's mind blowing. This sort of volatility for our currencies is unprecedented.
Mm. Do you think the government are doing enough for businesses right now to support them? I know there's talks of like VAT cuts, especially in my industry, rate reliefs, bits and bobs.
I don't know.
Or do you think it's their place to even bother helping?
I don't know. I think, again, personally, I think I would, if it was me in government policy, I would be trying to help people rather than businesses. I think most businesses, it's been a tough period with COVID, but, by going to businesses, you are helping productivity, potentially helping business owners, but can you go straight to individuals who are struggling? And I think, things like the energy cap, or the sort of rebate is going to help people. But I think a lot of government help needs to be more targeted. You need to help the people who are struggling the most. And I think there's an element of everyone's getting helped equally, and that might be the case with the businesses. So I think more targeted help at individual level is what's required. People who are struggling to pay their bills and people who are struggling to feed their family, they're the people meet their mortgage requirement. That's where the help's really required. My business like yours, we can, of course it hurts to pay more tax, but we can deal with it, right? And that's how it is. But
do you think they think that helping the business might help the economy as a whole, as opposed to helping the individual? That, how do I word this without being insensitive? Like, throwing good money after bad if they don't think it's going to make a positive change in their life by giving them financial help.
Yeah, I don't know. It's
a tough one, isn't it?
It is a tough one. I guess this comes back down to sort of economic stuff as well, right? The theory of what is the right, so again, an economic theory might say, right, put money into a business because that will create wealth and it will create productivity and that will then create employment and the society will benefit. That's a great theory, but there's going to be a lag in that, isn't there? Mm-hmm. Whereas people, if you can't afford to put your heating on, or if you can't afford to feed your kids, or you're making a choice about whether you feed your kids yourself, that's not something that can afford to wait for 18 months time or a lag. And let's see how that strategy plays out. People need help now, and I think that's where they need to get things sorted quickly.
For sure. Now, before you came on, I did a thing on my Instagram asking people if there was anything they wanted me to ask and not ask. There's loads of them that came through. A lot of it we've covered already, so I'm not going to ask. There was a few bits that came through, and one of them was, what is trickle-down economics? Does it actually work? Has it ever been proven to work before?
Yeah, well, trickle-down really is the sort of exactly what we've been talking about, this idea of supporting governments, sort of supporting businesses or supporting income. So, something like the 45% tax cut that was reversed is a good example. So the top 1% of earners pay less tax, they therefore spend more money, or they might invest it in businesses. This is the theory that then creates employment, creates jobs, and there's more jobs and more sustainable sort of income, and then that spreads to the shops, etc. It's a nice theory. Has it ever been proven to work? I'm not sure if there's any empirical evidence to suggest that that's the case. So I think there's a balance, right? Because I think if you've got, if you said, let's just play out sort of, if there was a tax rate of 100% on businesses, no one would run a business, right?
Correct.
If the tax rate was 0, then maybe everyone would run a business. So there's somewhere in the middle of those is the right outcome. So, but there's the thing is, it's about, you've got to make it a big enough incentive for people who want to take risk, but you've got to make, society needs to be fair. And the problem that I think the problem has been for the last, 20 years, 30 years, there's been a lot of wealth created in this country, and I think the redistribution of that wealth has been poor. All right, people have become very, very wealthy, and the difference between the people who have made the money and the people who are struggling is going the way of America. It's vast now. So I don't think anyone who's successful minds paying more tax, but it needs to then be distributed fairly to make sure that people who haven't got that are being looked after in society, as well as the people of success. And I think that's where the government, not just this government, but governments the last sort of 20, 30 years, while this country has made a lot of money, hasn't been distributed fairly and properly.
Well, let's hope the future they'll visit that and distribute it properly.
It would be great.
Is it likely, though? Looking at the history?
The problem is that you end up, again, you get two ends of the political spectrum, and that you need the centre ground. So the Conservative Party traditionally is about economics, and it's all about the textbook of reduce taxes, create employment, entrepreneurs, then create wealth that's distributed, the trickle-down effect. But does it trickle down, or do you get people who are making hundreds of millions of quid and that's what they've got? And if they're good, they might put back in some into philanthropy, but not everyone does.
Or it goes offshore.
Yeah, it goes offshore, that's right. It goes to Monaco, that sort of thing. So that's one end, that's one extreme. And the other side is then a sort of more Labour government, which is more socialist, which is more a sort of society of higher taxes to look after everyone, but that potentially can go against the entrepreneurial spirit, and businesses are going, well, if I'm going to get overly taxed, I'm not going to do it. The answer is in the middle. The answer is to create entrepreneurial, business-friendly society that allows people to have good ideas to make money, and then create on-tax companies and individuals who've made a lot to say, right, we now need to distribute some of this profit in a way that will look after the people who are most in need in our society. So the answer is in the middle. But we're joking about, the House of Commons, how much agreement in the House of Commons. You see it. I mean, either side looking at each other, just shouting at each other.
Yeah.
That's not a way to run politics. That's a run. That's just, it's pathetic, really, when you look at it. So there's no solving, there's no solutions. There's just arguments, and everyone's getting more and more entrenched in their sides. And I think that's a major problem with the political situation sort of set up in this country generally.
What I struggle with is they're running the economics of this country, right? So if we thought of this country as a business,
yeah,
you wouldn't run your business like that.
No, of course not.
I wouldn't run my business
like that. No, it's a shambles.
So why is it not being run? Take emotion out and politics out for a minute. If you run it as a business, it'd probably be the most effective way of doing it.
You're correct. Run it as a business and have people who've got experience and accountability, and say, right, let's bring together people who are specific, have got expertise in these areas. Of course, you want sort of input from the sort of MPs from different parts of the country, but they're going to be people who've got expertise, and they should be cross benches, so Labour and Conservative, and that's what we sort of say. Right, longer term. The problem with everything is a lot of these issues, people say, how do you solve productivity? You don't really solve productivity, i.e. how do we all produce more by reducing tax? You've got to have long-term. The way to do that is you've got to invest in things like education and infrastructure, and health. They're long-term 20, 30-year sort of investments. But if you're running a government that needs to be re-elected in 5 years, are you going to spend any money on that when the payback's 30 years? You're never going to do it. So what really needs to happen is these longer term spending things need to almost be taken outside of government and say, right, we are going to set up an infrastructure committee, an education committee, a health committee that will take long-term decisions on the investment of this money to make sure that the country succeeds over the longer term, not just about the short-term politics. And that's the start on how you would increase productivity. But it's a long-term play. It's the same with green energy. Green energy isn't going to be a vote winner because we're all paying more taxes to offset the green energy tariff. However, we all know that we need to remove the need for fossil fuel for climate change. We need to invest in green tech. That needs to be taken outside as well. So all of these long-term things need to be removed from government and invested with people who actually know what they're doing, who've got expertise.
Of course.
That's what needs to happen. But whether it will or not, these answers have been here for years. No one's taken them on.
Maybe it's time for you to step up.
Maybe it's time for someone to sort it out. Yeah.
So I hear what you're saying. So effectively you're saying because their term is only 4 years, they're so worried about getting re-elected, they're not actually going to deal with the larger issues at hand because they need longer than 4 years to fix those issues.
It's 5 years, isn't it? So they got 5 years in. Sorry. Yeah, that's right. And that's it. So they are looking at what is going to get me re-elected
in 5 years.
So if I'm going to I'm going to start paying.
So the first year they might do some good changes, and in the next few they're trying to get re-elected.
But you see it, and you see it every year. So the last year before the election, it's the giveaways. You watch the budget not next year, the year after, it'll be little tax cuts for everyone. It'll be those little tax cuts, little sweetness. Come and vote for me. I've just taxed your cuts. You see it every year. It's like what goes around and comes around. It's every time.
It must be frustrating for you because you can actually see it from a different perspective to most of us.
Yeah, exactly. But they say, what would happen if we said, right, we are going to put an extra 2p income tax on the pound. So every pound you earn, you're going to pay 2p into this long-term development thing, and people will just accept it. And if it was agreed between the two, across governments, between sort of, all the people in government, then that would work. And people could say, right, we are doing that there. But of course, if a Labour, whoever it is, Labour, Conservatives said, well, I'm going to put your tax up, right, we're going to get them out in the next general election because that's painful. So it just doesn't work.
What are the government bonds that Bank of England are buying, and what does that mean for us?
Right, good question. So government bonds, they're buying sort of long dated. So it comes back to what is a government bond? Basically, a government bond is when the government needs to borrow money. So they issue these sort of treasury notes, and they will sell them to the market. And what you do is you sell them. They have a period, which, 10, 15, 20 years.
Like a post-dated check?
Yeah, sort of, yeah. And you get your money back as long as the government doesn't collapse, which hopefully it won't in this country. And you get an interest rate. So you might say, right, I'm going to give you 10 million quid as a company, and then you will pay me 4 or 5%. And then as long as the government's ban still in play in that time, I'll get my money back, right? So that's what a government bond is simply. There are different types of bonds. You can have some inflation linked and some are just fixed coupon. The problem that we've had is all of the volatility has caused mayhem in a lot of pension funds.
Yeah.
So final salary pension schemes where you put in and pay over a long term, there aren't many of them around anymore, but they are what's called defined benefit. Mm-hmm. So the trustees know what their liabilities are. All the people retiring, they've got to pay X amount of money to those people. So the pension trustees looking after the investments have been buying sort of liability driven investments. What I mean by that is they're buying, it's the type of derivative. I get sort of technical with this stuff to say, I'll buy this derivative and that will give me the guaranteed sort of income or visibility of income over the long term. So I know as a trustee that I can pay all the pensioners their income. If you see, and the trustees will put up an amount of money as sort of collateral for those derivatives. And in a normal world, that amount of money you pledge shouldn't vary very much because government bonds they're not volatile, right, in theory. But what happened is that with the markets and the mini budget, the sort of gilt market or the government bond market went haywire. So all of that buffer of those sort of derivative and the sort of the margin, they've said, the banks have gone back and say, actually, because it's so volatile, you need to give us more cash. So in order to create that cash, they've had to start selling bonds. So it's like this death spiral where the more volatility there is, the more cash that the banks want as a sort of collateral against the derivative. And then you go down and down and down. And the Bank of England has gone, we can't have that. So we will buy those bonds from you. So we will create a market to buy them at a certain level to bring them back into the Bank of England. So they're basically just trying to stabilize the market. It's not, people aren't going to lose their pensions. It's just more of a short-term cash issue. But they by doing it that way, it's this sort of you're forcing people to sell in a downward market, and it just sort of layers on layers. But pensions are safe.
That's what I was going to ask next about pensions.
And the irony is with pensions, if you think about it, that if a government bond's now yielding 5% rather than 1%, and I'm trying to pay a liability to a load of pensioners, if I can get 5% on my money, that's a lot better than 1%. So actually, in many ways, the irony is all this stuff, that the gilt yield's going up is actually better for pension funds. It's just caused a short-term cash crisis. So it's not something to be overly concerned about. Again, although the media would, the language they use on this would make you feel like the end of the world's coming.
Yeah, and that was a lot of the questions we had in were about pensions.
Yeah.
I think people are frightened by
that's right. So
by the scaremongering.
It's all, there are, let's go back to there. So there's two types of pension. That is the sort of bigger, sort of what I call institutional defined benefit, final salary. Most listeners or viewers of on Instagram, they won't have that pension because they're they're rare. You might have one if you're in the police or a judge or something like that, or probably a politician. But normal people like us don't have those anymore. So we have a pension that's you put in some money every month, and it's a value, and it grows until you get to retirement. Those are traditionally invested in the stock market. So, of course, what you've seen a lot of volatility as the American market and the UK market and Europe goes up and down according to what's happening. but you still own the shares. If you own shares in like Apple or Google or whoever it is, you still own those shares. You haven't lost any money. What you've seen is you've just seen the value drop in the short term. Long term, it will go back up. So they are safe. Don't get confused with volatility as a loss. It's not a loss. It's just a temporary reduction. It will come back up. You only lose money if you crystallize it. So if I invest £100 and it drops to 80 and I sell it, I've lost 20 quid.
Got you.
If I invest 100 quid and it drops to 80 and I sit on it and it goes back up, I haven't lost anything. So the key with all this is to try not to panic.
Sit tight.
The great thing about pensions is you can't access the money till you're like 65 or 60 anyway. So if you're 25 or 30 or even 45 or 50 almost, there's nothing you can do about it. So you can't touch the money anyway. So you just try to forget about it and it will come back.
Yeah, I'm sure that will help a lot of the listeners.
Yeah.
Now, savings versus bonds versus investments.
Yeah.
What's the best option currently if I came to you?
It depends on who you are and what your objectives are and when you need the money. So if it's about short term, medium, long term, right? So if you need money, you're going to need the money you've got in the next 2 or 3 years, then cash is the best place to have it because you can't afford to take the volatility. Got you. Because you might put it in and it might go up, but as you're seeing at the moment, it might go down. So anything that's short term, you want to keep it in cash. Go to the bank. We do a lot with national savings, government backed, premium bonds, all that. Nice and safe, low risk. Probably get 1.5%, 2%, 3% now, maybe more. So it's low risk. Bonds, again, different types of bonds. So a cash bond might be where you tie the money up for a year or two. So you say, well, actually, I'm quite happy to leave it in cash, but I want to get a bit of a fixed rate. So you say, go to a bank, building society, and they might give you a little bit more because you're pledging that money for 2 or 3 years. You might get 3-4%. Then you're into longer term investments, which are equities. So what we talked about before, investing in the stock market, the global stock market, whether it's the UK, Europe, America. I mean, American stocks make up about 55-60% of global markets. So one of the things we always try to do with our clients is to say, if you're investing your money, don't just invest in the UK. The UK market's about 3 or 4% of the world's market. America's 55, 60.
Didn't realise it was that small.
It's massive. That's the thing. So when we look at our portfolios, most clients are way into, their exposure to America is 20 times more than they got in the UK. So they come to us and say, well, I'm really worried about the UK economy. It's like, well, don't worry about it. You must have a look at what's going on in America. That's the bit that we need to be concerned about, not what's going on in the UK. So long term, the right place to really compound growth is to be invested in the stocks and shares, and ideally in a globally diversified portfolio, which will probably lead to America. But that will be volatile, as you say. You've seen a lot of volatility this year. It goes up, it goes down, but remember, it's not a loss. It's a temporary decline, and as long as you sit on your hands, it will come back because markets have always come back and made good long term returns.
Just touching on the stock market, do you think it's at the rock bottom now?
No idea. No,
Can't really guess that.
No, never guess it. No one knows. It's that crystal ball. So all we would say is, if you look at markets year on year, 70% of the time they go up. Year on year, 30% they go down. Right. If you then extend that to 10 years, it will be 99% of the time they go up, 1% they go down. If it's 100 years, it always goes up. So that's why the term of the investment is so important. So that's why you say, so if you can imagine if 70-30, if that was cash, if you're a betting person, you might invest for a year, but I wouldn't feel comfortable. 30 is too high. You imagine shortening it to a day, it's probably 51.49. And you see
like roulette, that.
Yeah, a little bit. So the long term is stacked in your favor. This is where it comes back to data. If it's a long-term investment, invest in equities. If it's a short-term thing, just be very mindful of where you are and how shorter term, because it's too much risk, really.
What's one thing you think people could do right now to protect themselves financially for the future? Would it just be to save, have a rainy day fund? Is there any one particular thing you'd say?
A rainy day fund is good. I think for me, it's just being in control of your finances and knowing exactly what's going in and coming out. I think there's a danger sometimes that people get anxious and they don't open bills and it starts to get on top of people. So I would sort of have a look at your what are you trying to achieve with your finances, whether it's a short-term thing around paying off some debt, student debt, or whether it's trying to save up for a holiday or a wedding, or whether it's saving towards retirement, and just be crystal clear in terms of, right, what is the amount of money that I need on these dates, etc. I would then list out everything you've got. What are the assets that you've got? What's your income? How much do you earn net? And then have a look at exactly where you spend your money every month. We all spend money on stuff that we don't need to, right? So there's a bit of spring cleaning is always a good idea. Just get rid of go back to the direct debits. Right, I don't use that. I don't need that. That's expensive. I can get rid of that. So I think just going through that process is a good way of just becoming calm, like understanding exactly where you are, having an overview of it. And then you can work back to say, right, in order to meet this goal, I need to, potentially divert £100 a month or £200 a month, or same with the mortgage. The mortgage stuff at the moment is quite frightening. Don't wait for the fixed rate to come up. Get in control. Know what it's going to cost. Right, I know that in 2 years' time, as it stands, my mortgage is going to go up by £500 a month. If you start to think about that now, right, what changes potentially do we need to make to get ahead of it? I think you will, for some people, it will give you a bit more confidence to go, actually, I can deal with this, because it feels like less of a crisis. It feels like, right, I can deal with this. I need to build a strategy to come up with a way of doing this, rather than allowing it to get right on top of you. Then it feels like a crisis. So just get organized, have a think about where your money's going. Are there any short-term things you can do to sort of make yourself a bit more bulletproof? It won't be perfect for everyone, but I think just getting in control is a big advantage.
Yeah, very good point, guys. Everything's so doom and gloom and negative, isn't it?
Yeah.
I wanted to try and end on a bit of a positive.
Yeah, of course. Yeah,
because we're both quite positive guys.
Yeah.
What's, in your opinion, what's the positive out of all of this that we can take away? All the current, economic issues, or what's happened with COVID, or just generally in like what's going on at the moment?
I think there is always good stuff out there. So again, if you look at the globe and the world, we are advancing as a human. The human race is advancing. The stuff we are doing,
incredibly, isn't it?
Unbelievable. Like if you look at technology, what are we achieving there? If you look at health, the amount of people living in poverty is reducing massively every year. So we are, as a globe, a population of people, making huge progress in life. So I always try to come back to that, to go, the world is advancing. There are tremendous entrepreneurs doing amazing things at the moment. So again, we come back to investing. What are you investing in? You're not investing in a company. You are investing in brilliant minds of entrepreneurs who are doing incredible things. And so the question is, do you think that those brilliant people are going to continue to be brilliant and do brilliant things? And if you believe in that, then you invest in stocks and shares, because that's the human ingenuity is what you're investing. You're not investing in a share, you're investing in humans. So the world is advancing. We are doing incredible things. The bit we're going through at the moment is a blip. It's, part of the recession is growth. It just happens. We probably see this every 2 or 3 years. So it feels uncomfortable, but it's also normal. So yeah, but try to keep focus on the bigger picture of sort of the progress of humanity, and say, get your house in order and hopefully make yourself a bit more resilient in the short term.
Yeah. I think your outlook on it all is extremely positive, because I think probably from your financial background, whereas most people look at right now, you've got this thing about what you said about investment terms. You're looking at it from a bird's eye, and you're going, actually, over the last 10, 50, 100 years, it's all going positively.
Correct.
So you're sort of concentrating on that, as opposed to going, today I've got this issue to deal with.
And it's a good point. I mean, a great point that, we live in a world. So it's kind of interesting with stocks and shares that I don't know what to use an example. If, let's say, Tesco's did an online thing now, right? Tesco's have got 20% off everything today, right? We would all go down there now and fill up our groceries and be like, oh, this is great, have a party. The stock market goes down 20%. Everyone's like panicking. It's like, well, what you could do is just buy some.
Yeah.
And you get a massive discount. Now, I know that's an easy thing to say, because not everyone has got money to invest in the moment, but the stock market is the only thing, when it goes down in value, where everyone else moans.
Yeah.
It's an opportunity.
Yeah.
So again, a lot of this is psychology. And just the final point on that is, I always, and whenever I read anything, I always try to, my brain always, is there another way of looking at this? So if something is negative, can I reframe this in a way that there is actually a positive outcome from this? And I think in pretty much everything you can do that if you think long and hard about it. So, right, so house prices might drop, right, okay, that's a problem potentially, but will that then help first-time buyers onto the market? Yes, it will. Stock market's gone down, right, that's a problem. Anyone investing money now, right, you're getting a discount, that's fine. The government shambles it is at the moment, there's going to be a U-turn, right? Is that going to maybe lead to more people putting pressure on the government for better social outcomes and justice? Yes, it will do. So there is always a positive angle. You just got to, you don't assume anything you read in the press is real. Just to question everything and try to find the positive angle. There always is one.
It's quite a stoic mentality.
Yeah.
You said house prices are going down, but I've got a house. There's your positive.
Yeah.
I've got a roof over my
Correct.
head. This is going up, but I can still eat.
Of course.
But you can always find something positive.
That's right.
I agree.
And this, it's sort of, it comes back to this sort of, this idea of, feeling confident and looking at what you have got rather than what you haven't got. I think there's so much to be said for that. And we live in a safe environment.
Very safe.
And, a lot of us are very lucky. So I think don't lose sight of that. And, finish off with that idea. Not everything is about financial returns. Sometimes it's about health and well-being and family that are more important than, what percentage return you're going to get on your house price.
Anthony, incredible insight. Thank you so much.
Pleasure. Nice to do this. I've enjoyed it.
Thank you.